Hey guys, hope you are all having a great day today. Today, we are going to go over an interesting article from Bloomberg. This fine piece of journalism was published back in 2019, and it exposes one of Wall Street's biggest secrets into how they dodge taxes through a smart ETF trading tactic. I want to thank everyone that watched my morning video. I will link it in a pinned comment in case you missed it. We have a lot to talk about, but before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. On September of 2018, more than $3 billion were pumped into a tech fund that was ran by State Street Corporation. 2 days later, the same trader pulled out a similar amount. This is really weird. Why would an investor or trader make a bet and then reverse it so quickly? Transactions like this are apparently becoming more and more common, mostly because they are a practice carried out to dodge taxes, mostly performed by some of the world's largest fund managers with the help of investment banks. It is pretty wild the lengths they take to perform these types of schemes, as you are about to see. These type of trades, often called heartbeat trades, are rampant across the $6.6 trillion ETF market. Some ETF managers call them the industry's dirty little secret. The way it works is pretty simple. When you make an investment, you typically sell it at a later time for hopefully a higher price than what you bought it for. When you pull out and liquidate, you owe tax on these gains, but thanks to a Nixon-era tax law loophole, funds can use a technicality in the law to avoid paying taxes if the person running this scheme uses the stock to pay off a withdrawing fund investor. Heartbeats are the method used when there isn't an existing investor. Fund managers will ask a bank to create extra withdrawals by rapidly pumping assets in and out. This relationship between banks and fund managers to make transactions in order to avoid taxes would easily land any normie in prison for life, but the law has a blind spot for big money. If the IRS took a good look at this type of scheme, they would literally call it a sham, but they would honestly be helpless to stop it unless Congress made it illegal. Imagine it like this. Little Billy goes to a grocery store and buys milk, but then goes and returns the milk right after he finishes the purchase transaction. The grocery would then somehow get a tax deduction when the return transaction took place. Fund managers and bankers alike, when questioned about this practice, said what they are doing is legal, and excuse the moral bankruptcy of their actions by claiming that most of the taxes that their investors and clients avoid will be paid in later years. In the long list of clowns using this scheme is BlackRock, State Street, Vanguard Group, and many others. For the banks helping out, you will find Bank of America, Goldman Sachs, Credit Suisse, and many others. Spokesmen of these companies declined to comment on these trades when asked, a smart move probably advised by their lawyers. The IRS, when questioned, said that they are aware of heartbeats, but wouldn't say that they consider them to be abusive. Let me say that again, because I need you all to stop for a second and realize what the IRS did. When the IRS was asked about this sham, they said they are aware of it, but that they don't consider it abuse. Not paying taxes on some dodgy loophole, taxes that would be worth millions of dollars in each of these billion-dollar transactions, are not abusive, but if I miscalculate and don't report $50 on my taxes, I get an appointment with a judge. People, you literally can make this up. This is so loony that I am honestly speechless. Pioneer's ETF executives think heartbeats are a smart strategy, because it removes a negative from the investment process. When Bruce Bond, a well-known individual, was asked his opinion on heartbeats, he said, and I quote, "There really isn't a need to have to pay the tax every year, since the goal is to have the best investor experience you can have. Most of the heartbeats take place when an ETF has to get rid of stock because of a change in the index it tracks. As you all know, ETFs have grown a lot over the past couple of years. A big secret that America doesn't like to talk about is how less and less companies are going public, and instead what we are getting is more and more ETFs tracking different mixes of the same trashy stocks that are favored by Wall Street. Since ETFs have become more prevalent than ever, and seemingly appear that will continue to grow, you now know exactly why that is. ETFs are the new investment vehicle by which funds can avoid paying taxes through the direct help of banks. Guys, the fact that this isn't being talked about anywhere to the degree it should is perhaps the biggest crime of all. You guys might not fully understand the gravity of the situation, so let me plug in some numbers for you. As of 2018, more than $211 billion worth of taxes were avoided, based only on the report of around 400 funds. The real number is much bigger. That was all in 2018, where then were about 1,990 ETFs in the United States. As of 2020, there were 2,204 ETFs. The size of investors holding assets under ETFs has grown by a massive 147% over the past 2 years alone. This is absolutely insane. These same people got billions of dollars from taxpayers during the pandemic relief bills, and all that money went straight to their pockets. Anyone literally making any excuse for trickle-down economics can please kick themselves out of this channel. They are literally hoarding all the money and not putting it back in the system. No wonder why it seems there's a new banker turning billionaire each day. They come and make a big speech about working hard when in reality they just don't pay taxes at all. I don't ask this a lot, but for the love of MOASS, please share this video with as many people as possible. This needs to be seen by everyone. Let's now talk about today. The Fed submitted over $1.748 trillion in reverse repo operations today. Dark pool trades for AMC accounted for 60% of the total volume today, while dark pool trades for GameStop accounted for 42% of the total volume today. AMC had a larger amount of buy orders than its sell orders, with GameStop also having a larger amount of buy orders than sell orders. Now, let's talk about performance. AMC traded bullishly, gaining over 2% today. AMC traded fairly good during the pre-market, staying on top of the VWAP for longer periods of time. Upon market opening, after an abrupt dip that took AMC down to 29.06, it quickly bounced up, eventually running all the way to 32.23. After reaching this high, AMC retraced back to the VWAP line, where it bounced. It was not allowed to move past 31.40, so it ended up falling slightly below the VWAP before making another attempt to break that 31.40 resistance wall. It ended up failing, and that was when AMC started breaking support, eventually testing 30 again. Here, it would be attacked a couple times and eventually close at 30.30, below the VWAP. As for what to expect for tomorrow, AMC will have support at 30, 29 and 28.50. Resistance will be met at 30.83, 31.50 and 32.23. AMC is looking good today, but its inability to climb or attempt to break out through most of the day shows me that it could experience further weakness in the next 2 days of trading. Keep in mind that on Friday, the stock market will be closed due to Christmas Eve. I want to see AMC close above 30 for the week, which is why tomorrow it needs to show strength and at least hold above 29. Again, AMC performed good today, it's just that after that morning performance, it left much to be desired. GameStop traded bullishly, gaining under 1% for the day. GME traded really weird today, opening to a dip that took it to 155 and then a surge that took it to 159. After this, GME fell again, reaching 155 again and then was followed by a bounce that had it reach 160. Here, GME would once again fall, this time staying above 156 but not bouncing past 159. It would then trade back and forth, staying below the VWAP for a brief period of time but not far from it. After doing a double bottom at 155.52, GME bounced up, breaking past the resistance on the VWAP and running to 158.40. After some shorter attacks, GameStop closed at 158.12, below the VWAP. As for what to expect for tomorrow, GME should find support at 155.40, 150 and 147. Resistance will be met at 160, 165 and 168.50. GameStop built really strong support today, never once breaking below 155. I think there is an excellent chance for it to try to break past 160 again tomorrow, so I am bullish. That is all I have for you guys today. Thank you all for watching my video. Like I said, I would really appreciate it if you guys could share this video with others, maybe link it on social media or something. What these companies are doing is clearly way out of line, and we need all eyes and ears on top of them, so that we can ask for better treatment. I want to thank everybody that showed up to my morning video. I will be making the second half today and release it tomorrow. Just saw the reviews came out for the new Matrix movie and they are atrocious. I always feared it was going to suck, but I am still going to go watch it anyways. I don't know about you, but AMC theaters have been packed this Christmas, you can't even find parking lots. Is it the same in your area? Let me know in the comments. I will link this morning's video on the comments below in case you missed it. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day and to the moon.